I tell people this is not a rebalance your portfolio. You got to get out of the way of something this big, and it's once in a lifetime. This happens once every 90 years. This sort of level of a crash, 29 to 32.
Hello, everyone. Welcome to Wealthion. I'm Maggie Lake, and joining me today is Harry Dent, founder of HS Dent. Hi, Harry. Thanks for being with us.
Nice to be here, Maggie.
Before we jump in, just a reminder to all of you who are listening, if you have comments or questions, please drop them below. We'd love to hear from you. And if you want to take a fresh look at your asset allocation, you can get a free portfolio review from one of the advisors in the Wealthion network. Just go to wealthion.com/free. And we may all want to do that, Harry, after we talk. So you have been vocal about the fact that you believe we're headed for a financial crisis. What has you so concerned? What sort of macro framework are you operating?
Okay, let's step back for a minute. I was the most bullish person in the entire world, or at least the United States, by far, back in the 80s and 90s, when everybody thought, oh my gosh, Japan and East Asia is going to take us over. We've had our day in the sun. We're no longer leading the world in anything. And I'm like, no, look at all the high-tech industries. And on top of that, look at the baby boom generation. This was a global phenomenon, but we had the biggest, best baby boom generation and highest educated. And I was just showing people in the early 80s how they were going to cause the greatest boom in history into 2007, which even exceeded some of my predictions because I could show how big. I just lagged the birth index forward 46 years for the actual peak in spending of the average person in this country. It's 47 in a lot of other countries, but it's a very accurate thing. And it said, greatest boom in history. And then in 2008 forward, well, you got the baby bus dragging us down until now. Currently, the millennials kick back in, but the millennials will never be the force. Everybody says there's more millennials than baby boomers, but I look at the size of a wave for economics, and the baby boomers was a wave we have not seen before and will not see afterwards, especially as a maturing country in most developed countries. So the real story is, okay, well, 2008 hit, and suddenly, for no reason, boom, we're in the deepest recession since the Great Depression. Well, no surprise to me, but what was a bit of a surprise is the government's Ben Bernanke thesis was the Great Depression, Maggie. And so he knew what a Great Depression looked like. And I saw 2008 just like 1930, and he saw the same thing. So he just stepped on the pedal. And I know the Fed, he and the Fed and public officials thought, okay, well, this is just a short-term financial crisis. We'll get over this and we'll be back to normal. No. My research says, no, it's going to take 12 to 14 years to bottom, not till 2022, 23. And so that's why we've had so much stimulus. The first trillion turned into $27 trillion. Nobody's put that number out there. I counted it all, okay? And 19 of it is massive government deficits, and the other 8 or 9 is money printing, just printing money out of thin air and injecting it in the economy. The money that's the deficits goes more directly into the economy, and the money that is printed goes more directly into financial markets. So both economy is much stronger than we would have seen, and stock valuations and all are much higher than we would have seen. And we had, the greatest boom continue, crash in 2008, early 2009. But now we've had stocks go to massive new highs. So from my point of view, the biggest existential question for markets now is, did we successfully skip over what I would have seen as more like the 1930s? I have a 4-season cycle, and that would have been the deflationary downturn, 1930 to 42 part of the cycle over 2 generations, baby boom and millennials. Did we just skip over a depression and there's no cost to that? And now we just go sloshing into the millennials boom, which started at the beginning of 2024. And I think not, because the problem is people don't understand. Everybody thinks recessions are the enemy, especially Federal Reserve. Their job is to keep the economy growing at something like 3 to 4% with 1 to 2% inflation, and really never have a recession unless we really have to. Recessions are the best thing the economy does. I know this. I was a turnaround manager early on for Fortune 100 companies and then for small business. That's what I did in the 80s, turn around failing companies. Failure allows to wash out the losing companies, the zombie companies, they come in, restructure bad debts, which people never do unless they're forced to, and clear the deck so you can stay healthy and grow again. Recessions are necessary. We've had a major recession every decade, once a decade since World War II. And now all of a sudden, geniuses at the Federal Reserve, who've never had sex or run a business, by the way, okay, most of the economists there, I think that no, we should have an economy that always grows and doesn't have recessions. This is insane. If we stopped having recessions, innovation would crawl to a damn near halt. Because people are at their best, and anybody knows this in wartime or crisis, people become heroes, when there's a crisis, and so every day enough. So to me, it shows the misunderstanding of the economy by the people who are supposed to be steering it, which is number one an error. Free market capitalism says we don't need steering. We need rules. We need rules of how to play and compete fairly. We do not need to steer the economy. We let it grow from the ground up. That's exactly what the invisible hand, Adam Smith invented this whole concept in the late 1700s. He called it the invisible hand. What I say now, folks, is all we have is the visible hand, and it's doing the wrong thing. It's suppressing the economy from flushing out the massive bad debts and zombie companies created in the last greatest, and it was the greatest boom in history. And nobody thought that was going to happen except for me back then. People thought I was crazier than being bearish now. They thought I was crazier in the 80s for saying this was going to be the greatest boom in history. Everybody thought the United States was done.
Yeah, and by the way, we're hearing that again, but we'll get to that. So let me ask you. I hear you talking about two things. Malinvestment and population issues. So let's talk about the malinvestment first. The sort of period of zero interest rates. I'm assuming this is what you're referring to. The medicine that the Fed gave in order to prevent the wheels coming off, a depression-like downturn, which is what we were at risk of.
Make money, pour money in the economy, and make it low bar interest rates.
And arguably, when they did that, they didn't think it was going to last for the better part of 15 years. That was supposed to be a short-term remedy, but your feeling is that it lasted way too long.
It's been 16.3 years, and they're still doing it.
So what do you identify as zombie companies, or the sort of bad decisions that were made, the bad debts? When you look across the economy, what does that look like? Because a lot.
Well, there's two things. They do measure. Zombie companies are companies that are only alive because they're not paying their debt service. So they're able to barely stay alive by operating, but they have to stiff their creditors due. So they're basically technically in bankruptcy, but still operating. So that's something you can measure. And we have record numbers of zombie companies.
Are they in the Russell? Is it all the money that happened in the private credit market?
They're probably more private companies, because smaller companies, that aren't public. Even the small cap companies are huge. In the big realm we deal in stocks and stuff in the stock exchanges. So it'd be more small companies. But no, there are plenty of large companies that are in the same position. The other thing, Maggie, is there's an excellent measure of this. Only Lacey Hunt, my favorite economist out of Austin, Texas, is called money velocity. Money velocity is only positive when, and this is the whole economy, it's measuring government, consumers, and businesses. When all of us are investing money, getting good returns on it, and then reinvesting those returns and getting return. Money velocity will only keep going positive if that's happening. Well, guess what it's been doing since 1997, right after the first tech bubble stopped? Falling like a rock. Guess what the last time it did that was? 1918 to 1932. The entire roaring 20s bubble was saying what you said earlier, malinvestment. Unproductive investments are being made. Why? Because money's so easy, and not having recessions to shake out the zombie companies and all this sort of stuff. So money velocity has had a bigger drop this time than it even did into the Great Depression. So money velocity would have been the number one indicator back in the Roaring '20s that would say, wait a minute, this is not a normal healthy boom. This is a bubble boom. A lot of overinvestment, a lot of malinvestment in unproductive things that are not paying off and being reinvested. And money velocity reflects that long before the economy does. So this should not have been a surprise to anybody. Economists don't study this because they don't like it.
Yeah. So let me ask you, obviously the Fed had embarked on an extraordinary hiking cycle, and with the thought that it would perhaps take out some of the excess in the economy that you have identified, but it didn't. It didn't have much of an impact.
Let me describe excess for you. Out of that 27 trillion I described, most of it, 40% of it, 11 trillion came from COVID, the 2 years after COVID. So they're the ones that caused the 9.3% inflation. They're the ones that forced them themselves to pull back and tighten. They were tightening an economy already running away because they dumped 11 trillion of it. It's like 80% of GDP in it. A couple of years. So they,
when you say that,
overreacted to COVID.
This is
now
the government
it's,
as well as the Fed, right? So this is the fiscal side as well as the monetary side.
Yeah, and remember, the fiscal side was 2/3 of all this 27 trillion stimulus, including that 11 trillion in 2 years after COVID. And the money printing was 1/3. So it's been the government deficits. And now we've stopped printing money. They even reduced the balance sheet 2.2 trillion. So that's starting to tighten, but the government deficit's still 2.2 trillion a year. So we're now getting closer to neutral instead of stimulative or tightening. But to me, in an economy in this big a bubble that's so overstretched with so many bad debts and zombie companies, even neutral's not. I mean, the only way to keep a bubble going is to keep upping the ante.
Right.
That's true of any bubble, any exponential trend in history. So they're in a bad place. And again, they created the stimulus. If $1 trillion a year for a couple of years wasn't enough, then they should have let the economy go in a recession, okay, and let the economy flush out and clean up the economy, because the economy is very good at that, by the way. It does it very quickly, very efficiently, because it's merciless, and it just lets the companies go that can't survive a shakeout, and it cleans it out, and nobody has to make the choice.
So if that's the case, why do you think the bubble is close to bursting now, or what's the trigger that's going to
because they're not feeding it enough. They're not feeding the beast. The last exponential jump was the overreaction to COVID. That was their big. If you're going to do this and to me, it's reckless, irresponsible, something for nothing, living on stimulus. None of that's good stuff. It's like taking a drug until it takes you over. Okay, any addiction has the same outcome. Okay, it takes more and more and more, and then until you just fall on the ground and damn near kill yourself. Okay, so what they did, COVID would have been the perfect time to say, oh, wait a minute. Okay, we got this outside influence. Everybody's a little sick. Okay, well, that would have let the economy shake out a lot of this excess. But no, they doubled down and stimulated more than ever. That was the mistake. And that caused the 9.3% inflation out of nowhere. That forced them to ease up to tighten strong. This is the strongest tightening since 1980-81, which caused the deepest recession back then since the Great Depression. So they created this all themselves, and they don't understand what drives the economy.
Since the Fed has attempted to tighten and is resisting calls to ease right now, trying to keep a handle on things, what's the role of fiscal? Would you be pushing through a spending bill that increases the deficit even further? What should Congress do?
No, but that's the problem. It appears to most people, they dropped the balance sheet 2.2 trillion. They raised interest rates 525 basis points. They're tightening. The deficit's larger than ever. And okay, I can tell you one thing right now. If I'm right and we're close to going a recession and you got a 2.2 trillion deficit at the top of a boom, that deficit would double to 4 trillion in the first year of the recession and keep going up. Now you see debt going from 36 to 38. Next thing you know, they're projecting 50 trillion and blah, 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 blah. And then the bond market starts raising yields and say, oh my gosh, the 10 and 30-year treasuries don't look like like
Right.
risk-free bonds anymore. And now you got to pay 5-6% interest. They gotta charge 5 to 6% interest instead of 4, and blah 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 blah.
Yeah.
And so this is just over stimulus. Everybody believes in free market capitalism until something goes wrong.
Right.
And people think recessions are bad. Recessions aren't bad.
I guess
That's
what
my
I'm asking
message to
you
everybody.
is you're using the pronoun they. They let it go. So I'm just trying to get a handle on if the Fed has tried to do what it can with its toolbox. It sounds like the they you're referring to is on the fiscal side of things, which is Congress that
It's
needs to
both.
act.
The government has not run a balanced budget since 2001. And I'm just counting the deficits, 19 trillion since the 2008 recession. They have reacted by just saying, well, we'll just keep running bigger and bigger deficits. And the Fed is saying we'll keep printing money when we need to. So what they do is try to just artificially stimulate your way out of a Great Depression, a big shakeout. I like to call it a shakeout. Shakeouts are necessary in business. I have a model in every one of my books. Innovation, growth boom when they first move mainstream, shakeout down to the leaders that really bring it cost effective and make it mass affordable, and then a maturity boom to mass markets. 4 stages, 2 booms, 2 busts. The booms are longer than the busts. It's all a natural cycle. And suddenly my problem is the people, especially at the Fed, governments too, governments just doing what they do now. People at the Fed think they should make the economy a machine that just grows at 3 to 4% a year with with 2% inflation and no recession. They're saying that, which means they've totally rejected free market capitalism, the thing that's made us the richest in all of history. You can't even compare the last 250 years to any period in history with the progress we've made since free market capitalism and democracy got married. And by the way, those are opposite concepts. That's the way they work.
So, if the shakeout is inevitable and should happen in order to usher in the next period of prosperity, what is the nature of this fallout? In 2008, it was sort of rooted in housing and then spread. What do you think? What does this shakeout look like in your mind?
Yeah. Well, I tell you what is most unique, Maggie, about this downturn. The Roaring 20s was majorly a stock and a business. I mean, an unbelievable stock bubble and business bubble and all that sort of stuff. It was not a real estate bubble. Real estate loans back then were 50% down, 5-year terms, and you had to be much richer to qualify, okay? Now, real estate is the biggest part of this bubble, and it's global. Everybody's been able to buy real estate at almost no money down. Now, forget 10 or 20% down, almost no money down at very low interest rates. And so that's what's allowed there to be so much debt. And again, there's nothing wrong with borrowing in a boom as long as it's some relationship to the actual growth, and and you've got a great gauge that no economists pay attention to because it would tell them they're doing the wrong things most of the time. Money velocity.
Right.
If money velocity is flat to going up, it's meaning this is healthy growth. If money velocity is dropping, it's saying no. Businesses and consumers and governments are not investing money productively.
So, Harry,
that's a bad thing. That means the debts are not going to be able to be repaid.
If real estate has been too loose, people would argue from 2008 that credit standards tightened a lot in the wake of the subprime mortgage, and that it has been harder to get a mortgage, and we are looking at higher interest rates.
It was a short period of time. It was.
Yeah.
There's never been an easier time for more people to borrow. I mean, again, the Roaring 20s was roaring. It was not roaring for real estate because borrowing was not easy. And even in the Roaring 20s boom, with same thing, near zero inflation, low interest rates, there was not the borrowing surge there was, except in business.
So do you believe that we are likely to see another wave of defaults? Is that what happens?
Yeah, I think real estate's going to have to. I've got 2 targets. They're extremely simple. And let me jump back real quick. Anybody that I study charts up the wazoo. Anybody that reads charts and they saw the charts long-term charts of real estate and of the stock market, like say the S&P 500 NASDAQ, they would say, oh yeah, we're in a big fifth wave top and we're going to have a wave crash that's going to go back to the fourth wave low. The fourth wave low is March 2009 for stocks. You know how big a stock correction that is? 94% for the NASDAQ, 86% for the S&P 500. You know how much that is for the average house? 60 to 70%. This would make the 2008 downturn where housing went down 34% and stocks went down 57% look like nothing. That's what the charts say. And what it's basically showing you is how much longer and bigger this bubble was than the bubble that led to the tech crash in 2000, 2002, and then the generational bubble peak that led to the downturn 2008-9. I call that 2008 downturn 25 years before it happened, down to late 2007, because that's when the baby boomers would peak in their spending and shift the momentum down with Generation X. So very simple math.
So if you are expecting that sort of economic wealth destruction in this downturn through housing and both stock market, you're talking about two areas where people have a lot of their net worth. How do investors prepare? Is there a safe haven? What do you do?
First thing, there's going to be winners and losers. Who are the winners? The young people coming along that have to buy a house and can't afford one, okay? And now that they've gone up, they're 4 times what they were just 20 years ago. And that's what you do. You have to look at your assets and say, look, where am I supposed to? A lot of people I know have a main house and have some sort of vacation house. Well, at least sell one of them. A lot of people in the main house are thinking of retiring in the vacation house anyway when their kids get totally out of the nest and they retire. Okay, well, sell. And I would sell the one with the most equity and not the one with the most debt, because if you get a real debt crisis, banks are going to be forced to write down a lot of these loans that they made. They're the responsible party. They're the smart money here. You can't blame the average person for saying, well, everybody told me and the banker told me I could borrow this much. I didn't do anything wrong. The banks lent all this money to ever appreciate the same house that's now 4 times the price it was 20 years ago. It's the same house. It's not like a stock that's grown and has new markets and is moving into Asia. It's the same damn house, 4 times the price, and people lend and borrowing up to 90 to 100%.
So sell if you have multiple homes, or if you can sell.
You sell
take advantage,
any real estate. Look at your real
can.
estate first.
Yeah.
Same thing. Stocks are easy to sell. The good thing about stocks, if you say, well, I don't know if Harry's right or not, well, you can wait, but I'll tell you another fact I've researched throughout since the stock market was created. The first crash of a bubble, not a normal bull market, of a bubble, is 42% in 3 months. So that first crash, if you wait till then, you're going to get whacked really hard, and then you'll sell, but you'll already be down a lot. And then you'll sell, and then it'll bounce halfway back, and you'll think you missed that. And then it'll keep going down and you'll end up looking like a hero in the end. But it's just, you sell any real estate you can. That's the most important, and erase those debts for yourself. And sell stocks. And if you're going to wait on something, you got to sell the real estate now, because real estate clams up quickly. If you say, okay, sell your real estate now, and then if it keeps looking like I'm right, then sell the stocks too. That'd be a stair-step way to do it.
And where do you, what do you do? Do you stay in cash? How do you feel about bonds? They used to be a safe haven, but a lot of people have been questioning if that is still the case.
Yeah. Well, all you have to do is look at 2008. And I've got a lot of people here in Puerto Rico, Peter Schiff, and a lot of people who have the same story I do: bubble, overspending, over debts, got to burst, financial bubble. And they say buy gold. Well, in 2008, gold did hold up at first, but it eventually went down with everything else and ended up being down about 40%. Well, that wasn't the worst place to be, but gold is not the safe haven. There is one safe haven, Maggie, and all you got to look at is any deflationary downturn in history, like the 30s or in what we've seen in 2008 and 9, treasury bonds, the longest term. The best thing to appreciate and will be the safe haven, much more than gold, would be 10 and 30-year treasury bonds, and the 30 years even better. There is an ETF called TLT, which is half 30-year, half 10-year treasury bonds. That's the best ETF to buy. That went up 40% in 2008 when everything, including gold, finally went down. And this time I'm projecting TLT could double. Just that simple little ETF with 10 and 30 year, the highest quality, lowest risk bonds in the world could double in value if we get as deep a recession as I see. In other words, and I tell people the way, how do I rate this downturn? They cut the 2008 downturn early, okay? It would have been deeper longer. This downturn should be roughly stock declines, real estate declines, 1.5 times as bad as 2008. So if you thought 2008 was tough and you barely got through that, well, now you'll see why you really especially got to sell real estate, because again, you can be wrong about stocks. They could crash 40-50%, but then take back half of that and you could still get out there and only be down 20-30%. Okay, it wouldn't kill you, but if you don't get out of expensive, especially high-end real estate, you'll never get it out at a good price, and you'll lose a lot of money.
If you have any questions about how to navigate the current environment, Wealthion can help connect you with a vetted advisor to get a free portfolio review. Just click the link in the description below or head to wealthion.com/free. There's no obligation, and it will just take a few minutes of your time. Again, that's wealthion.com/free. Thanks so much for joining us. How do you feel about Bitcoin?
Bitcoin is proposed as a safe haven. Not. I love Bitcoin. Okay, it took me a while. I noticed that it was acting just like Amazon and the .com stocks in the 1994 to 2000 bubble, acting just like it. So I knew that this crypto was the next big thing. I didn't understand why at first. What did they do? What does Bitcoin do? Well, a guy was speaking at my conference years ago, and he said, it's the digitization of all financial assets and money. And I'm like, oh, now I get it. I'm the only guy in the world that right there could have told you $630 trillion in financial assets globally. The biggest financial number in the world, 5 times global GDP. So if crypto is about restructuring and making highly efficient, tradable, carvable, anything, manipulatable financial assets in a time where more and more people are becoming millionaires or near millionaires, everyday people are retiring as millionaires, that's going to be a big deal. So that's when I got, this is the next big thing. And so crypto's the big sector, and coming behind that close, something I always touted, I call it the automated of professional and managerial jobs in my Roaring 2000 books way back, AI. So automating business and management. So that's NVIDIA and a bunch of stocks around that area. So the first things I want to sell, these are the most bubbly stocks, from Bitcoin to NVIDIA. Look at them. Both of them have bubbled more than anything. When things crash, those would be, if I had to buy 2 things coming out of this, it'd be Bitcoin and NVIDIA, because those are going to be leading the 2 supercharged sectors that are in their innovative stage about to move mainstream once we clear out this crash. And again, it's another reason. My thing is, get the damn crash over. If you carry all these debts and all these zombie companies on your back into the next boom, if we somehow wiggle through this without a deep recession, the boom's going to be compromised by carrying all that extra fat. And it's going to be fat. That's why the economy gets rid of them. That's why recessions are necessary. And again, we have had a substantial recession once a decade since World War II.
Is there any
and
way,
our economy's only got stronger because
is there any way, along your lines of thinking, there's a downturn is necessary? I presume
the downturn is necessary. It will never happen without it.
presume that you do not feel like a depression is necessary. Is there a way to mitigate or to cushion so that we get the reset you're looking for without the collateral damage that a broken system or a depression would bring?
Okay. There is a way, but first of all, if you're going to blow up financial assets to 5 to 6 times GDP, and that's what it is, okay, and they're going to come down at least in half, you're going to that's where money gets destroyed. It's not pulling out the money or the money's already, this is in people's net worth and balance sheets, okay? That's going to get destroyed if this happens. The only thing you can do to mitigate this, and there's no way to turn it into no recession, you might be able to have a deep recession instead of depression, is if governments were to turn around to the banking system and help accelerate this. In other words, say, look, what we're going to do to cushion this, instead of just running deficits and stuff, we're going to, every dollar you write off in bad debt, we're going to take 30, let's say 30% of it, some decent percent to give the banks, and get, it's a limited time offer, banks. You got 2 years to do this. Any debts you write off, we're going to take 30% of it. We're going to take that on our debt because we borrow cheaper than anybody for the good of the system, and then help mitigate this so it becomes, but there's no way to have net worth of everybody drop this much and zombie companies go under, because there's a ton of them now, without at least a deep recession. But yes, it could be 10%, 12% unemployment. The Great Depression was 25. And Maggie, that's one of the things I tell people. The difference between a recession, even a deep recession, and a depression is depressions follow bubble booms. When financial assets get way out of line with the economy, not just growth and plants, equipment and stuff, financial assets get overinflated, and that much money suddenly gets pulled out of the economy in the crash. 29 to 32. S&P 500, these are blue chip companies, went down 89% and did not get back to there for 25 years.
Are you concerned?
That's why I tell people, this is not a rebalance your portfolio. You got to get out of the way of something this big, and it's once in a lifetime. This happens once every 90 years. This sort of level of a crash, 29 to 32.
Are you concerned that if we start to see a financial crisis, that officials will pull out the same playbook of '08? Are you concerned that
they will? That's what they'll do. And at some point, the markets will say, "Didn't you do that last time?" And now we're in a bigger. That's all we've done since the early '80s. Every time there's a recession, we stimulate our way out of it, then we end up in a worse one because the stimulus causes a bigger bubble and stuff. And we've had 2 bubbles and all this sort of stuff. I mean, I'm telling you, if you stand back, see the difference with me. I'm not in the system. I got out of the system when I left Harvard Business School, okay? I went in the entrepreneurial realm. I started my own business. I consulted the entrepreneurial companies who created the future. I could care less about Fortune 500 companies. They're gliding from the past, okay, and moving into the third world now, okay? So I don't see recessions as bad. Recessions are part of the process. It's the shakeout. Innovation, absolutely necessary. You don't have new trends. Growth boom, they got to first prove themselves in niche markets and to the upper classes. Shakeout down to the ones that really survived that. And then the maturity boom takes it to everybody. You know that nobody had a car in 1900, 1914, only a couple percent had cars. And by 1929, 90% of people who lived in cities had an automobile? That was a huge step in society. It happened in this 4-stage progression. If you compromise the 4 stages, you don't get there, or you don't get there as strong. So they're messing with free market capitalism. That's my gripe. These people who've never had sex, and I'll say that, never had sex, or at least look like it, never run a business, guaranteed. Any Fed chairman you pull out, okay, probably. And they don't understand the economy because they don't understand that failure. George Gilder was my favorite economist because he celebrates failure.
So
it's failure that accelerates success as well as success.
Let me ask you
can't have success.
Let me ask you about another narrative that's floating around, that in this next shakeout reset that will come. I think a lot of people agree with you that in some way, shape, or form, maybe not your exact,
in some way, at some time,
maybe not your exact scenario, that this time around, the U.S. exceptionalism has ended, and that it is the rest of the world that will outperform now, and that this is the decade for emerging markets, for some of these countries and you're not going to see that downturn is not going to be the refresh for the US. It's actually going to happen elsewhere. And the safe havens or the opportunities coming out of it are not going to be in US companies.
Okay.
They're in.
This is a very good point, very good question. Number one, yes, we're in the maturing developed world. All developed countries are maturing. You know the one's going to last the longest? Australia, because they get massive immigration of educated Asians. They're not getting uneducated people coming across the border from Latin America. They're getting educated people from Asia. So Australia, if I pull up Australia's spending wave chart into the future, it looks like an emerging country, okay? But most developed countries are peaking and plateauing for a while and will eventually decline. We're the best house in that big neighborhood. Us in Northern Europe are going to hold up a lot longer. Southern Europe's already declining. Japan, South Korea, China, already declining in demographics, okay? And China's the first emerging country to peak and decline. They're still going to be developed countries, and we're still going to be richer than most emerging countries for a long, long time. I'd say almost forever. So the U.S. is never going to grow like it did in the 50s and 60s or even 70s, 80s, and 90s, but we can still be a modest growth economy and still the wealthiest major country in the world if we clear out these debts and get and at least make the most of a slowing situation. So it's that simple. This shakeout will make everybody stronger except the weakest companies and weakest economies. And we're not the weakest economy in the developed world. We will come out stronger out of this relative to Europe than we are now, and much stronger. Japan is already dying. I was the first guy to say in late 80s that Japan is the one that's going to burst. Everybody said the U.S. was going down. I said Japan's going down because they aged first.
Do you still feel that way?
Absolutely. Japan and South Korea are the fastest aging countries. And in the emerging world, China's the only, especially large, emerging country that's already in an aging pattern. They're going to lose 40% of their population in the next 50, 60 years. What does that do to you? That's not growth. That is shrinking.
So you're
Japan, South Korea, China shrink for as far as we can see for 50, 60 years.
So you're bearish those regions now. I wonder, as somebody who pays attention to demographics, how you feel about technology and robotics. You mentioned being very bullish AI. Does that change your focus on demographics into the future? Maybe not right now, but in the future?
No. Every technology. How many farmers do we have in the country now? About 2%, producing more than we can eat by far. And we're one of the biggest exporters in the world. What happened? We made them more and more productive. And so farmers went into factories, and then factory workers went into offices, and officers went in, and people go into upper management. And then with the biggest trend today, Maggie, and what's going to happen with AI? Entrepreneurship. I'm an entrepreneur. 1989, I became an entrepreneur and left everything in the corporate world. Bain and Company, consulting to Fortune 100, working for Fortune 100, everything, and went into the entrepreneur realm where you create something that doesn't exist before. That's what I call radical innovation. Everybody's involved in some sort of incremental innovation, or you can't keep your job or advance in life. 1 or 2% of people, the Jeff Bezos, just to be extreme. What did that guy create? And then look at it. Was he lucky? No, he named his company Amazon from the beginning. He saw it being the widest river in retail, not just another river. He saw that. That's a visionary. And he looks crazy half the time, okay? Well, I like people like that. I work in the entrepreneurial realm. It is a realm of people who take risks, who do not fit in, and do something that didn't exist before. That's the real value added. And this is what the U.S. still does better than any country in the world. So that's why we're still going to be the best house in the maturing neighborhood. We still have high immigration compared to other developed countries. And people talking about cutting. No, the last thing we should do is cut immigration. We should just make it more legal, and make it more official, and not have people hiding and stuff and all. Our immigrants are what keep us growing. Without immigration, we would be a shrinking country, and people don't admit that.
Right.
So, and that's why also Australia is my model. They have high quality, high income and educated immigrants, not lower than average, that are going to rise. They're having people come to their country that are already at the level of their people who are entrepreneurial and are going to get better on top of that. Australia, if I had to invest in just one country and just let the money sit, it'd be Australia in the developed world.
Interesting.
So, but the developed world is all plateauing and eventually slowing. And you're right that the other 8 billion going towards 10 billion are in the emerging world. And they are, I'm telling you, I've done all the projections, and people think people in China are going to be as rich as in the U.S. Never. Not on any of our lifetimes. They'd be lucky to get up to 30,000 GDP per capita versus our 85. And that's going from 5, which is a huge 6X, okay? Yeah. The emerging world is not going to be as rich as us, but there's many more of them, and they are. What you said earlier is 100%. All the growth in the future is going to come from the emerging world from about here on out. We just want to be the best house in the developed world in the US.
So let's finish on this thought. And it was, I'm glad we were able to touch on areas that you're bullish on, as well as what you're concerned about.
I'm again the most bullish guy in the world. You can't have booms without busts. So if anybody says you can be bullish and never be bearish, then they're an idiot. They don't understand. They're like the Federal Reserve people who don't understand the economy. Can't have booms without busts.
And so let's end on timing on this. And no one has a crystal ball, but what is your,
well, especially now, you're right.
What is your time frame? So if people are thinking about trying to take your advice and reduce their exposure to real estate, maybe take that equity out and sell the home, move into TLT, which are the things that you're looking at. Yeah. Timing is terrible. Nobody rings a bell at the top or the bottom.
That's right.
What are you expecting? Is this an event you see happening this year?
I think it's now because they were finally forced by the overreaction of COVID, forced them to go the other way and tighten. And this tightening is going to hit more in this time frame. So I think if the economy doesn't start going down in the next year, then I'm going to doubt. The other scenario, Maggie, is really simple. You just go into the sunset and mediocrity. You carry all these debts and zombie companies. You're a weaker economy, less productive, but you don't take your hits and shake it all out. So, but you still have some positive demographics and positive areas and technology. And so we have a muted boom in the future, or just fade slower in the sunset. That's not a preferable strategy for me, okay? But that's what's going to happen if we don't allow the economy to wash out these debts. And I'm telling you, the economy can do this in 2 to 3 years. 29 to 32, after booming for 25 years, early 1900s, roaring 20s, bubble, pinnacle there. Washed it all out in 2 to 3 years. The economy is very good at this.
So you see this,
and it does it without judgment.
You see this as a second half of 2025 or 2026 type event?
Yeah, I see that we're most likely to be down 26 into sometime in 28 and be coming out there. But again, it has to start first. And there's a good chance we've already peaked in February or here maybe in June in different indices. I'm tracking where when the difference between a long-term top and a medium-term top is you get a long progression of the money moving into the safer, higher quality, in other words, from the NASDAQ to the S&P and from emerging countries to developed countries, moving to higher quality assets until they get the most overvalued and finally they go down. So we're seeing that progression in the last couple of years, okay? And a lot of things already peaked back in 2021, including the Russell 2000 small caps, and they do not look like they're going to make a new high here. So that is already a divergence. That's the classic divergence. Large caps keep going up in the last stage. The small caps don't follow. The generals without the troops, as they call it. So that's already, and there's many divergences like that in the world. Bitcoin is going crazy here. Ethereum is falling like a kite. They're number 2, and they can't keep up. Okay, so Bitcoin's really the dumb money comes in the most at the end. I hate to call them dumb money, but they're just the last, and they buy the obvious stuff like Bitcoin or Microsoft or Apple. They don't buy the smart money. Picks all types of interesting small caps. They can find some winners and losers and pick the winners. So everything's saying we're getting increasing divergences, increasing new highs, and everybody thinks like it's going to go forever. But this is exactly what long-term tops look like instead of short-term tops like, 1987 or 2000. Those were short-term tops. 2007, another short-term top. So this is looking like a long-term top to me. So I say get out of real estate as fast as you can. Look at that the hardest. And start getting out of stocks. And if we can get through next year and we're back, we're still at new highs, then you may just have to say, look, I'm just gonna get back in stocks. I'd still stay away from the real estate, get back in stocks, and then just have a tight trade. But so they have made it tough. It would have been a lot easier if this thing would have peaked. I have 2 cycles that are very clear. And I call Wayne and Beth. The late 2007 was the demographic generation spending cycle top, and that happened. That's why we had all this stimulus and downturn that nobody expected. And the innovation technology cycle peaked in late 2019, early 2020. And that winter cycle goes into 2032. So that's the only cycle still negative, but that's the one that always has the bubbles and the leverage in it. So I think this bubble still has plenty of room to burst in the next several years. And I'm rooting for and preaching for do it now. Get it out of the way. The millennials are coming to their boom. We're only compromising their boom, us aging baby boomers, because we own the assets and they don't. They're the winners. The younger people are the winners if we have this shakeout. It's the baby boomers, the older people who own the overvalued financial assets. They're going to lose. Now, if you're the economy, okay, and you don't care about John or Jimmy or Susan or Helen, who do you want to win here? The up and coming generation or the one that's going to die in the next 10 to 20 years? So what's favoring the millennials is what's best for the economy, and that is a crash in financial assets so they can buy a house again and they can invest again. What are they going to invest in if they come into their investment years from 50 to 65 with assets this overvalued?
Yeah, no.
They're not going to have anywhere to make money.
And that's a really important conversation. And I can't think of a better place to end this with that. That everyone can go into a bit of soul searching about population and the rural demographics are going to play some.
And talk to your kids. You got millennials. Talk to them. They're the ones that can really benefit from this and do the right thing here the easiest. Which means they delay buying a house.
Very interesting stuff. Harry, this has been a really fascinating discussion. Thank you so much for being with us.
Okay, thank you, Maggie.
If you have any questions about how to navigate the current environment, Wealthion can help connect you with a vetted advisor to get a free portfolio review. Just click the link in the description below or head to wealthion.com/free. There's no obligation and it will just take a few minutes of your time. Again, that's wealthion.com/free. Thanks so much for joining us. We'll see you again next time.